Good morning, good afternoon, or good evening. It's great to see you continue your journey in Forex trading. Today, we arrive at lesson number 4. In the last video, we talked about what major currency and cross currency mean. In this video, we will focus on margin account and leverage. When you want to trade in the Forex market, you need to open a margin account with a broker. A margin account is an account that involves borrowing money from the broker in order to increase the positions that you could open with relatively small amount of money. For us to use margin account, we need to understand what leverage is. Leverage is the ability to control a large amount of money by using only a relatively small amount of capital. We call this small amount of capital margin. Margin can be expressed in the form of dollar or percentage. Now, let's take a look at an example. A broker only needs you to set aside $1,000 from your current account to open a 100,000 position. This means that the leverage you were given is 100 to 1. The margin in this case is $1,000. We can also say that a margin that's required here is 1%. And here is a simple mathematical formula explaining how we arrive at this 1%. Why do we need leverage? We need leverage because daily fluctuations in currency pairs are relatively small. Most currency pairs have less than 1% change in the currency value, and this makes Forex market a relatively low volatility market. That is why we need to use leverage in trading currency pairs. The ultimate goal is to increase the value of potential movement of currency pairs. Another important concept of margin account is leverage rate. The leverage rates for different currency pairs might be different. The most frequently seen leverage rates are 50 to 1, 100 to 1, and 200 to 1. And you may want to consult with your account broker about leverage rates for different currency pairs before start trading. Leverage rates in different countries might be regulated by different regulatory bodies. In Canada, the Forex leverage rate is regulated by the Investment Industry Regulatory Organization of Canada, or IIROC. The highest leverage rate for USD to CAD currency pair is around 45 to 1. The leverage rates for all other currency pairs in Canada are below this rate. For us to understand the power of leverage, we will use 3 examples. Let's say you want to trade 100,000 USD worth of USD to CAD currency pair. With no leverage, you will need 100% capital or margin. That is 100,000 US dollars. How many of us actually have this amount of money? Probably very few. With a leverage rate of 100 to 1, however, the margin that's required to trigger this trade is 1% or 1,000 US dollars. With a leverage rate of 200 to 1, the margin required is even less, that is 0.5%. And this means you will only need 500 US dollars to trigger the trade. Leverage not only allows us to use a smaller amount of capital to trigger a trade, it also means a better rate of return. Just a quick reminder, rate of return is the profit that you gain divided by the margin used in the trade. Let's say you make the trade and you gain $500 profit. With no leverage, this means a rate of return of 0.5% only. With a rate of 100 to 1 leverage, that is only 1% of margin investment, the rate of return is 50%. Now, if the leverage rate is 200 to 1, your rate of return is actually 100%. This means you double your investment. However, leverage also is associated with risks, sometimes greater risks. Let's say you incur a loss of $500 instead. We will apply the same formula, rate of return. Here it will become a negative number. That is loss divided by margin used in the trade. With no leverage, your loss is 0.5%. With leverage rate of 100 to 1, the loss is actually 50%. If the rate is 200 to 1, your loss is actually 100%. That means you lost all of your investment at the very beginning. As we can see, leverage is associated with risk. Leverage is a double-edged sword. It can help increase your profit, but it also could mean an increased potential loss. Newbies must take into account of what risk you are taking when trading Forex. One way to minimize your loss is to set a stop-loss order, and we will discuss what this means in more details in lesson number 7. In the next lecture, we will discuss lot and pip. I hope you enjoyed this video. Follow us on www.marketnewbie.com to find more educational materials, as well as our Facebook page and Instagram page. See you in lesson number 5.